me a chance.
Last song, I couldn't even get my mic on. Yeah, just randomly cut out. Oh, this song was playing. I didn't have my mic on. Let me just play this. But anyway, I was like singing, right? I noticed that there's reasons like this that happen. This would be considered an ICT order block.
All right, so what is... So, we're looking at the...
This is the video for exactly the video 2 of it. This is one point at it right here.
It changes the state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. See, you guys don't even know what you're talking about. You're trying to teach my concepts, and you have no idea what you're doing. You're talking about things in the left side of the chart. Trade it. One consecutive bearish order block. The opening price, extended out in time. Why is this a good bearish order block? Because it has that gap, and it's taking liquidity. And there's a market structure shift. There's your high frequency, high power, high probability bearish order block. Forget everybody else's interpretation of my concept, the order block. That's it. Okay? What is an order block? You see a lot of people asking, what is an order block? Only my students in mentorship know what an order block is, okay? What it is, it's a change in the state of delivery, okay? It's a change in the state of delivery. The market's being offered higher, 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 higher in these two up-close candles. How did this series of up-close candles begin? With this candle's opening, right there. That opening, once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there. And that's why it's sensitive. The algorithm remembers that right there. Okay, that's all I'm going to give you on the free mentorship level. But that is your answer. Okay, that is what an order block is. It is a change in the state of delivery. Much in the same way, all of this movement down here, all these down closed candles, the opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, why is this a good bearish order? And there's another fair value gap right there. Trades up into that as well. This is a 1 minute chart. So it's giving you multiple points of execution that you could trade on.
I believe it's the 2022 mentorship, if I'm correct. Right, video 3, 2022 mentorship.
And then dives. See these two candles here? That's one consecutive bearish order block. The opening price, extended out in time. Why is this a good bearish order block? Because it has that gap and it's taking liquidity.
And notice, right, he points at the green candles. He don't points at the candle before the fair value gap. He points at these candles, the opposing candles before the fair value gap. The green candles before what would be considered the red candles usually, or the buy side candles before the sell side candles.
And there's a market structure shift.
Right,
There's your high
now.
frequency, high power.
Order blocks ICT 2020 2 EP3 order blocks ICT 2022 EP3. Let me see what he says one more time.
Here, market breaks down, trades break back up into this, So we're looking at the swing lower here. Market breaks down, trades break back up into this, fair value gap here, and sells off. And there's another fair value gap right there. Trades up into that as well. This is a 1 minute chart. So it's giving you multiple points
He's on a 1 minute doing this at that.
of execution that you could trade on, and then dives. See these two candles here? That's one consecutive bearish order block.
And I'd be confused what they mean by bearish and bullish. Bears attack, swiping their claws downward. Then you look over here.
The opening price, extended out in time. Why is this a good bearish order block? Because it has that gap and it's taking liquidity.
That's what I mean by I can't learn from these videos, because he says bullish, but we're looking at a bear. He says bearish. Wait, what did he say?
Extended out in time.
Bearish.
Why is this a good bearish order block?
Why does it call it bearish order block? I'm just seeing what this is, really. So they call it the opposing name. See, that's why I'd be confused. They call it a bearish order block because it's an order block of the opposite side before a bearish move. Now look me in the eye and tell me that's not confusing. They'll be saying bearish order block. I'll be thinking this right here. The first candle before this move right here. This candle right here. And it's not even the first candle before that move. So how? Right. So basically price just seeing colors that ain't got no rules. They ain't trading into them, just matching back up with them. Well, that's nice research to know. See if that's happening on ICT channel too. Basically what I'm seeing is and I know it's being told right here in front of me, but I'm trying to understand this for myself. I don't know how to have it explained for a way that I get it, then in a way that I could teach it to other people. What he just said made 0 sense, but I understand where he's coming from though. Because basically what he just said is prices balancing out these ranges right here. Because as you see right here, boom, right here, you would call this probably an order block, from what I'm guessing. Price came back up into it, consolidate a little, and ran up. And if you come over here and look, this would be the order block just like this one right here. But it's not green though. So you look at this one. So boom, all the way there. You see it? Cool. You consolidate right here because this happened right here. You look right here, consolidate right there. Why? Because that happened right there. Come right here, consolidate right here. There's no fair value gap, but there's one right here. On downward, so come here, boom, look over here. Where's the side meet at? Somewhere over here. And as you see, these candles right here just equal out in this range. So it's just a balancing act.
Because it has that gap. And it's taking liquidity. And there's a market structure shift. There's your high frequency, high power, high probability bearish order block. Forget everybody else's.
So order block is. So order block. The opposing candles before a FVG. What do you call the candles at the end of a FVG? That was something that's been on my mind for a while too. Let's continue watching though. See what else.
Interpretation of my concept, the order block. That's it. Okay. What is an order block? You see a lot of people asking, what is an order block? Only my students in mentorship know what an order block is. Okay. What it is, it's a change in the state of delivery. Okay. It's a change in the state of delivery.
But what's that mean?
The market's being offered higher, 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 higher in these two up-close candles. How did this series of up-close candles begin? With this candle's opening right there. That opening, once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there. And that's why it's sensitive. The algorithm remembers that right there. Okay, that's all I'm going to give you on the free mentorship level. But that is your answer. Okay, that is what an order block is. It is a change in the state of delivery. Much in the same way, all of this movement down here, all these down closed candles, The opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. See, you guys don't even know what you're talking about. You're trying to teach my concepts and you have no idea what you're doing. You're talking about things in the left side, trying to be cutting the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it?
This is the IRL I was talking about. So basically these candles overtook this sell side candles over here. And it pulled down back to where this happened at, this area right here. And that'll be the opposing candle for this price leg right here. Then it went up again, came back. Why I did that? This candle right here. And then that makes sense because it's like there's candles in front of this one, but this is a whole price run right here. So basically this like one leg and this right here is just like another one. Just came back and rested a little bit in this area right here, this range right here. Then it ran up again, and if you look, you see like these like two near equal highs right here. They're around the same region. Then it came back down, and you notice these wicks.
It be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. See, you guys don't even know what you're talking about. You're trying to teach my concepts and you have no idea what you're doing. You're talking about things in the left side of the chart. Trade it, do it, okay? You don't even know what you're looking at. And you're hurting the people that you call your students. And then right away, when people don't know how to use them or understand what to do with them, they'll say, well, this stuff doesn't work, because they learn from somebody that doesn't know what they're doing, okay? It's blatantly obvious what it is, but okay.
What he meant by buy stops is like the tops of these candles right here. You see these candles came, ran up. Once it ran past this one, it ran past these highs too. Then once it ran past these highs, it ran past these highs right here. Is there a way I can draw on this? That would be nice. I would draw like a circle here and then a line right here going straight, and you'll see like it broke past that. Draw a line here, going straight. Boom, it broke past these too. I was reading out my notes earlier, now I see what I'm talking about. But what role does the order blocks play in this? The order blocks play the pullback. So, okay. So this trend came, hit a liquidity void, if you don't know what that is. I'm talking about this region right here. I don't know why he's showing that. But that hasn't called liquidity void. No, see? This is what happened right there. Yeah, it's right there too. I guess it just don't matter how wide it is, but yeah, this is what I call liquidity void right here. It's like these big candles and these big fair value gaps on each side. And they're very close to each other. Oh yeah, I did get the certificate, but I just failed it on purpose. Cause like, I ain't got my ID yet, so ain't no point in it. Could've saved it, yeah, but nah. I'd rather just pass it again. Anyway, yeah, though. So it made liquidity void. And I had on my paper, when I see liquidity void, that means reversal. Let's see, just based on the pictures themselves. Yeah, see it right there. See it right here. See it right here. See it right here. Right there. Right there. See it right there too. Okay, so that, I just pick out the ones that I liked. Liquidity void. Boom. 15 minutes though. 1 hour. Went down. Yup. 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 Even right here. They came back up a little bit past to its high, but came back down past that and it ran up again. Even right here. Then led to a reversal, led to a continuation. I don't know.
Okay, same thing here.
But yeah, order blocks. What's the best way to say this? Order blocks form above old swing points. Order blocks form beyond previous swing points / liquidity. Huh. That's what I'm right. Order blocks form past old swing highs and lows / old liquidity. I think we really need to differentiate that, because liquidity is where buy stops and sell stops are located. But yeah, it get thrown around so much. When it comes to liquidity, just think about where people placing their buys and stops at. And when you look at it, people be placing their buys, their like stops right here because it's on the downtrend. So boom, liquidity would be in this area right here. That's why this block happened right here. Liquidity would also be above these highs. That's why this block right here. Liquidity would be above there. That's why it wicks past that. Then liquidity would be past there too. And then as you see, it comes and wicked it. Then it came back down. Then it ran back up and cleared all that liquidity. And once all that been cleared out, there's no more liquidity left over here except but under these lows. And as you'll see, it came down here, it came and made it equal. Instead of going out taking out instantly, gave you hope it'd probably go back up. Then no, it came back and ran through there. Boom, taking out all this liquidity down here. And then, you see, right past there, it came and consolidated. It consolidated a little bit, then it ran past these lows. This old liquidity, with a fair value gap. Then it pulled back, and guess where else it went? Right here. And what's on here? This right here. Wait. I'm gonna screenshot this and see how right was I about that. If I got that right, I just seen something. It'd be best if I go on edits, paint, right. I wanna make like equal lines. I love this sound. I think I just figured something interesting out. Because as you see, this is that order block I was mentioning earlier, where this is a regional order flow. And I see why it happens. Order blocks and order blocks / order flow. Okay. Then I just figured out liquidity. Huh. Order flow and order blocks. Order flow and order blocks happen past old swing points because of liquidity stop. What do you call it when stop limits? Oh, that's interesting. Order flow and order blocks happen past old swing points because of liquidity stop limits. Is that what they call stop limits? I know I got this cheat site, Quagmire, favorite site in the world for all this type of stuff. Yeah, it was on the cheat sheet. You know I'm deep into this. Buy limit. Yep, limit orders. It's not called stop. Yes, limit orders is what they're called. Because of order flow and order blocks happen past old swing points because of liquidity limit stops. Because of because of liquidity limits or liquidity limit orders. Right. Also, liquidity is spots where limit orders are placed. I got all that just from 2 minutes and 52 seconds of this video and previous knowledge from a year and a half so far. This is gonna make about 2 years I've been trading pretty soon. Probably towards like next November, I'll say. Yeah, probably towards November. It'll be probably around 2 years.
Buy side is being offered.
Okay. So far I got down the opposing candles before a FEG. Am I right about that? Yes, I am. I just figured out something else too. So price breaks trend direction. So it's like I'm trying to figure out like a good way to like say this without mixing the two concepts together. Liquidity is where stop limit orders are placed. That's all liquidity is. So when I say order flow and order blocks, that's like seeable, that's tangible, but the liquidity aspect is it is just like conceptual. It's like abstract. I gotta find the right words for this stuff. It's like a split, so order flow happens because of the dot of liquidity. It's not even a dot, but all of it together is called liquidity. What's the best way to say this? Liquidity is the spots where limit orders are placed. Order flow happens at those spots. Order flow happens past those spots. And fair value gaps. Fair value gaps happen. Basically, I'm saying like fair value gaps run to those areas, or fair value gaps deliver price to those past those areas, which leads into order flow. Yes, because as you see, it's like order flow. I'll use my mouse and show you what I'm seeing. Order flow, fair value gap, order flow, fair value gap, order flow, fair value gap, order flow, fair value gaps. And as you see, order flow, fair value gap, order flow, fair value gap, and order flow, fair value gap, order flow, fair value gap, order flow. It would have been a fair value gap right here, but this candle right here came and wicked it. But it wouldn't even been right there either. That's interesting. So all of this order flow, then you got the fair value gap. Oh my gosh. Then order flow, fair value gap. Goodness, man. Order flow, fair value gap, order flow, fair value gap, order flow, fair value gap, order flow, fair value gap. Okay. Price moves order flow to fair value gap. I'm making a video right now, but anyway. So basically, wait, let me restart that. So basically, I'm writing down notes from what I noticed that's happening on the market right here, and I just stopped thinking, and now I can see like everything happening on this chart right here. Basically, what I'm seeing is a order flow for value gap, order flow for for value gap, and then it just keeps on repeating that. And then even like right here, order flow for value gap, order flow for value gap, order flow for value gap. So basically, oh, that's cool. 2 minutes and 54 seconds of just thinking about something, was stopping and looking at something, and I'm figuring so much out. Price moves from order flow to fair value gap, and from fair value gaps to order flow. That's all it's doing. goodness. So far, liquidity is spots where limit orders are placed. Price moves from order flow to fair value gaps, and from fair value gaps to order flow. Oh my, that's a crazy discovery. It was called ERL to IRL, but you look and realize like it was never no ERL to IRL to begin with. From this swing point to fair value gap, the swing point, fair value gap, swing point, fair value gap, swing point, but there's no fair value gap right here. It's always been an order flow, fair value gap, order flow, fair value gap, order flow, fair value gap, order flow, fair value gaps, order flow, fair value gap. Like, that's insane. I just noticed, what the world's going on right here? Why is there no skip button? It's only a replay button. That's odd. Anyway, so price moves from order flow to fair value gap, and from fair value gap to order flow. Why does it do that? And it does that because liquidity. So in the future, price should move below this low and below this that leads the question, will it come higher or lower? Oh, that's interesting. But these lower points right here, why are these there? Why do this and this exist? Like, what's above here that liquidity is above there that causes this point right here to happen? But this action right here. I want to be able to explain everything going on. I want to be able to explain everything going on right now. So this is all order flow and fair value gaps right here. All of this in these regions. And that's just the broad way of looking at it. Broadly, the market moves from order flow to fair value gaps, and from fair value gaps to order flow. But what's with these wicks? Why did this wick came back down to here? And it came back flip zone. Does it always have a wick like that in the order flow? Okay, order flow has a big wick there. Order flow has a big wick here. Order flow got a pretty big wick there. This would be the fair value gaps. Order flow has, oh goodness. And that's the crazy thing, right? I just sat here looking at a still image for about 10 minutes now. Was it 10 minutes? I don't know. It's done been about an hour. I think it's been an hour. I don't need to know the purpose of every candle. I just need to know the purpose of the major moves. Consolidations ain't really matter that much. I need to know why these fair value gaps happening, and like why these candles wicking back into them and continuing upward like that. And you know, I was thinking about like this this is what we call an inducement right here, right? Because it came up, looked up, show you was going up, but then it came downward, taking out this liquidity. That's not even liquidity for real. The liquidity would be right there. That's why it's a fake. But those who don't know will place their stops right there. So my main problem is like liquidity. Thinking like seeing liquidity. Liquidity will be everywhere people place their sell limit or their limit orders in the market. So what I think somebody placed, they'll place limit orders right here because of those right there, and because this price floor right here. Because they'll think like, right, it couldn't go past these. It made like equal levels right here, so ran up. But then it came up, then wick past that to these blocks right here, which what ICC say, have your stop loss right there, your limit order right here, just in case this week will happen. Okay. And as you see right here too. So the top of the first candle is where you place your stop limit from your fair value gap. But that's the thing, in the live market though, you won't be able to see none of this stuff until after it's happened. So based on that, what would be the best spots to entry at? Because you won't know the entry down here unless there's like previous price back here. And And that's the main problem I know is, right, like live markets versus like looking back at the markets. This shows you what the market did, but as it's being printed, how do you know? You wouldn't know. You have to like ER, IRL, well, order flow to FEG, fair value to fair value gaps. I think that would be the perfect way to say it. Fair value to the fair value gaps. Or like concept wise, fair value gaps to order flow. And that happens because of liquidity. There's so much layer on this crap. They ain't got these wicks too. Like, if you could enter on a wick, that would be perfect. But you look, you wouldn't know, because you would think this would start going up, but then it instantly sells again. And this came back to this spot right here multiple times, like 3 times, and then it ran off. For real. To that point right there. Then this wick right here came, broke past that, then ran up. How can I make something? What would be the best spots to entry actually? Most likely it would be right here. How would I notice what happened though? Because if you're not looking like past this candle right here, you wouldn't notice it's gonna go down. So bump all that. I'm gonna come right here. But even right here, you wouldn't know. You probably wouldn't realize or know until this candle right here happened. But even then, there'll still be some doubt. So let's see what ICT says.
So we're looking at the swing lower here. Market breaks down, trades back up into this fair value gap here, and sells off. And there's another fair value gap right there. Trades up into that as well. This is a 1-minute chart. So it's giving you multiple.
Mind you, this right here sells off because there's no more liquidity above these highs right here. Like all this sell stops ended with this area right here. So once it came broke this area going up, it's no reason for it. Because now you got sell stops right here, sell stops right there, sell stops right there, sell stops right there, and sell stops right there. But will the market come take all these out? I don't know. But I know there's majorly one right there, so I'll probably have to wait for this to be formed. And as I see it moving up, I'll probably try to enter, but usually I'll just end up entering in directions like this right here. So I'll wait for this liquidity right here to be taken out, or this swing point to be taken out. Well, I can't say liquidity, I gotta say swing point, because that's what this is. But there's liquidity right there though, because of that swing point. Sell stop orders are placed above this swing high right here, or this lower high right here, since it's on the downtrend. And because of that, sell stops are there, which is going to lead to price coming here and reacting to it. It's going to scrum right here a little bit, or just make order flow right here. And once you make that order flow, boom, you entry. So as you see these two right here connect, once those two right there connect, it's like the entry zone, this point right here. Because I can't confirm like what's going on right there, I'll just be guessing. If I don't want to guess, I enter right here in this area. It did touch this block right here, so this will be a block. I look through these candles right here, boom, my entry on this candle right here for this wick right here, and then I ride that up. And that'll be like a nice little, how many points is that? I'll just say it's around like 620 to 6. Ooh. That's, I'll say like 614, 610. Yeah, 14, 610 all the way to, if I got it right here and just held the whole time. Oh, I'm seeing it. 1486. 14,860. If I had $1, that would be $250. Huh. So it'd be like 250 points. That's insane. And usually I'm trading like 100 points per. I'm trading like $100 per point. So that would be $2,500. That's insane. I might actually use that since I figured that out. But then I was just thinking, right? I'm gonna write that down so I don't forget it though. But I was just thinking, right? Hold up. Entry. But how would I know that's not an inducement? Just have to trust the process, I guess. That's a reversal entry model. Actually, I just figured something crazy out. Yeah, that's insane. Reversal entry model. It's not even for reversals. I can use this on anything actually. Hold up. I just figured out where the entry at. With like crazy precision. Then it works well for live markets too. Not just, you know. Entry on old swing points being traded past that wouldn't be too bad actually. Because you know, if you look, it doesn't actually break that low, it just touches them a little bit. Entry on old swing points being traded past using the order block formed and the order block will be this area right here, will be this block right here, because if you notice and look at the rest of them, I can't say order block because this point right here don't even trade into none of this right here. There will be considered the order block though. I'm not using that though. That's not consistent enough. That's too random. Goodness, man. What am I thinking about? There's something I'm trying to remember. It's not the swing point on the entry yet. It's something else it's called. Because I don't know what to call it. We'll say enter on the swing points, but those just wicks. And it's not like definitive enough. Oh man. I guess I'll call them long wicks. Extended wicks. That's not a good classification for them either. That's what I was remembering. I wanted to find a way to enter on wicks. Oh, and now I see it too. You can enter on a wick by using the liquidity from the previous area. Because as you notice, like, right, every time there's a wick, it's like a liquidity point being traded past, and then it wicks back down into it. Dang, I just figured that off the head. Dang, that's crazy. I would say enter using swing points being traded past using the order blocks form. But is that always true though? I mean, I look right here, yeah. Trace back. That's the thing though, it's like a whole candle wick in front of this. And that's where the problem come in at. Cause I know it'll be easy to get that confused with. Then this isn't an opposing candle right here. This candle isn't opposing anything. It's just a indecisive candle. And there's a bunch of those type of candles. So me saying enter on an indecisive candle would be insane itself. You need something concrete that doesn't change ever. Because if we got too many variables to it, it's easy to get confused. Oh, my music stopped. Why is this so hard to put in words? Like I can see what I'm trying to say, but I can't say it really. And that's what I mean by like tangible things and like abstract things, I'll say. Cause like it's all liquidity, right? It's all basically where the stop limits are placed at, is where the market goes to. But when you try to like visualize and put in words like why this is happening, why that's happening, all you can say is liquidity. Even though it's like certain things happening at that point. Like for example, right here, I'm looking at these swings right here, right? And I want to say we can use order blocks to figure out where a swing point's gonna be at. But when you look right here, you see what I'm saying? It's not just the order block, it's got two candles right there. And this would technically be the first candle of a fair value gap. But you look right here, this isn't the first candle of a fair value. Wait, is it? This is the first candle of this fair value gap right here. And then this right here will complete it. This is also interlaced, it's crazy. But you see right here, this isn't the first candle of a fair value gap. It just trades into the fair value gap area. But then if you look right here though, you make a line right there, you see like it's the top of this region right here. Well, there's liquidity at. You see what I'm saying? It trades into this area above old liquidity, even though it's a candle right here, a fair value gap. And it went from a downtrend to a higher uptrend. So I guess the best way to say that is like, I figure it out. I'm erasing the entry model I just thought of because I found a better way to explain it. I'm gonna have entry models, and this is just gonna be the reversal entry model. Found a way to conceptualize it without it being too vague and unspecific. So boom, right? This is the first high. This would be considered the first high before a the first high of a So this would be the first high of a reversal. Like this right here would be the, ooh. See, that's what I mean. It's like tricky to say. this fair value gap goes up, and this is the first high. Then it's the pullback, and then it runs up to break the structure. So you got this candle right here, and you probably already understand what I'm saying, but I don't understand what I'm saying. So it's like, would this be a first high? That's what I'm gonna call it, the first high. Yeah, I'm gonna have to call it the first high. So entry model for reversal. But that's the thing though, I'm looking right here. I see this is a lower high, then this makes a higher high. Then it pulls back to this lower high. And then you look right here. This is a so basically I was looking at this first leg right here. First moment price switch is okay. So boom, price switch, right? Price switch goes up, make a higher high, and it comes back down to this previous, what do I call it? Cause like, that's the thing, right? You see this first price leg, but then it trades back into this price leg, and where it trades back into this candle right here, this area right here. And the reason this is, I'm having a hard time finding exactly what to say, because I already said this is order flow, right? And it's trading into liquidity. So entering anywhere right here would be good. But if we want like precision entries, we're entering on the wicks of this liquidity. Well, like, where is the spot that this constantly happens at? Well, I don't need to be perfect. If I was trying to be perfect, I would just say it's somewhere in this area. It just gave you a little bit more space to enter at, I guess. Because if you even notice, right, both of these candles are like dojis. They both have wicks on both ends. Then if I come up here and look, alright, so boom, it shifted down, then it went down, then it pull up, just pull up. And you see what I mean? Also a doji right here too. Well, wait. So it's the first move of that switch, then pull back. And as you see, boom. You see, it's the wick right there as well. Pull back to that wick right there, and then it continues to run down. Then not only that, it also occurs right here. But I'm trying to look for the extremities, the external liquidity, how that's moving right now. I understand the internal. Matter of fact, I'm gonna do it like that too. I'm gonna have an external entry, internal entry. That's really all I'll need. Then I have precision entries. Yeah, I gotta do it that way. I'm gonna have that on a whole different page. Just don't put that on the same page as this stuff because yeah. I'm gonna just have a whole page dedicated to my entries. Let's have a page called entries. Dang, so entry, first entry. Well, dang, that's insane. So when you think about how many entries can I have? That's actually worth it. I'm not gonna do pullback entries. I'm gonna do dang, that's insane. I don't need to trade the corrective moves. I just need to trade the impulses because they are worth more. I'm thinking too far ahead. So I'm gonna do IRL since that's the most common type. I'm not even calling it that. I'm doing internal. Internal range. Entries. 1. Wick into order flow. I can't say wick, I'll say pull back into order flow. Cause like in live markets as everything is moving, I don't have that much time anyway to tell if it was a wick or not. How would I not know it's a reverse? I guess that's where the risks come in at. Oh my gosh, I just thought about something else. So for the current price leg we're in, right? How would I know? Goodness, so many questions. So I'm erasing that. I'm gonna just describe how the market moves internally. And I think that's where the problem be at for real. I'm just writing order flow to FVG. Then I'm gonna write down arrow. Because the order flow happens at the swing. Put down arrow, swing, 2, break. I put order flow, I put swing under order flow and break under fair value gap, because the fair value gap leads to breaks that leads to order flow, which it becomes swing points, and then the swing points go to fair value gaps that leads to more order flow, which creates the swing point. Yeah. Yeah, that's perfect. That's perfect. And then this is just like general entries. And then like external entries. Turn. No range. Entries. External range entries. Oh, that's how I found it. I ain't got no more lead in this pencil. I don't use it all. That's some BS. Anyway, so last swing, before reversal that gets traded into past the that get traded into before the that get traded into before the last swing before the reversal that gets traded into the last swing, which would be right here, that gets traded, the last swing before the reversal that gets traded into through. That's right, through it, not before it, through it. Through last swing before the reversal that gets traded in, that gets traded through last swing before the reversal. Okay, that'll be this area right here that gets traded into pull back into last swing before the reversal that gets pull. Ooh. Back into. That gets pulled back into when order flow is made on new on last swing before the reversal that gets pulled back into when order flow is made. That's perfect words for that. So boom, 2 entries down so far. So the general entries: order flow to fair value gap, swing to break, follow wing trend, following trend. Following trend direction. No, following FVG. Following FVG direction, fair value gap direction. And the reason I say that is because it's follow. Oh, I can't say that. I'll say following dominant direction. Following dominant direction. I could just say trend at that point. Might as well just say following trend direction. Alright, just following trend direction, because that's all that is really. Internal range, entries, order flow that makes the swing to the fair value gap that breaks to the next that breaks old swing that breaks old swings. Simple as that. That's insane. And then my external entries is the last swing before the reversal that gets pulled back into when order flow is made. Oh, and I can just add like a little tip. For precision, use the connecting of wicks well, I can't say wicks. For precision, use the nearest candle made. But now question comes in, like, where would I place my stop limits? No, not thinking about that. Where would I place my stop limits? Got the entries down, but where do I place my stop limits? If the market targets liquidity and I enter, I'm gonna use my mouse so I can show y'all this. If price targets liquidity areas like this area right here, this area right here, and this area right here, where would I place my stop loss, my limit orders at, if I know liquidity is gonna take them out? Liquidity only takes them out on the next, on the trend reversals. So as long as I can get these areas right here, I'm safe. But how would I do that? Order flow to fair value gap. Yes, somewhere in the region order flow is made, right? Well, no. That's my exit I was thinking of. Stop loss would be... Okay, so the stop loss on this would be right under my entry. I got the entries, but where would I exit at? I just basically found like a zero risk entry strategy. Zero risk entry strategy, I just found it. How would I protect myself? How would I protect myself on like reversals though? Cause like, yeah, I can entry right here and get this move right here, but how will I know when to exit? Cause I mean, I'll get this move and probably get out right here. Yeah, how would I know when to get out? Because what's the point of an entry if I don't know when to exit? You know what I'm saying? So I found the perfect entry, but what would be the perfect exit? And this is on the 1 minute time frame at that, so going there and lowering this would just be detrimental. If I wanted to exit, it would be somewhere on these wicks right here, but I probably won't be able to get that. But I'll be able to make more money. So internally there's more money to be made. But also I could just catch this point right here downward. Well, not catch this point, but catch this point right here. And ride this downward, then get out. I see it. This reversal point right here. That's only for that right there though. But also this point right here. Alright, I enter on this order flow right here, then ride that up. Then I guess my eggs would be like, you know, that is right. Cause I would like to get out on these cones right here. It was running up, then it made a candle about the size of this. So can I just use the candle body? If I use the candle body right here, I'll just be getting out right there. Shoot, that's fine. I'll make more money. I don't gotta be greedy. Of course. That's perfect. Let's use the first opposing candle? No. That'd be too scary. Can I just say when a fair value gap is made? I'll figure that out. You know what? That's actually insane when I think about it now. There's never really a good place to exit. Ideally, I'll always be at the swing point. Aha. How about when the order flow is made? When order flow is being created, we exit. And there is no more liquidity. Like this never get straight back into until next range happen. And if I did so-called enter on this wick right here, and then I'll also enter on that wick right there, so it's like I just have to exit as soon as I see this invalidate. Exit on new opposing order flow or inverted gaps at extremes at extremes, well, no, at externals. I mean, I think that would be the best place to do it. Because if you know, it's like right here it gets invalidated. And then you got these big candles right here too. And you would think like this would pull back higher, but just make it equal high and then continue downward. I can't be too precise. I done made like 3 entry and exit models and then figure out where I press my stops at. It's just a little above my entry, you know. Should have like limits for that anyway, but still.
Points of execution that you could trade on, and then dives. See these 2 candles here? That's 1 consecutive bearish order block. The opening price, extended out in time. Why is this a good bearish order block? Because it has that gap, and it's taken liquidity. And there's a market structure shift. There's your high frequency, high power, high probability bearish order block. Forget everybody else's interpretation of my concept, the order block. That's it. Okay? What is an order block? You see a lot of people asking, what is an order block? Only my students in mentorship know what an order block is. Okay? What it is, it's a change in the state of delivery. Okay? It's a change in the state of delivery. The market's being offered higher, 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 higher in these 2 up-close candles. How did this series of up-close candles begin? With this candle's opening right there. That opening, once this candle trades below it, that changes the state of delivery. So you go back to that point of reference right there. And that's why it's sensitive. The algorithm remembers that right there. Okay, that's all I'm going to give you on the free mentorship level, but that is your answer. Okay, that is what an order block is. It is a change in the state of delivery. Much in the same way, all of this movement down here, all these down closed candles, the opening on that candle starts this series of delivery on the downside. When that opening price gets violated here, it changes its state of delivery. Now it was offering sell side. When it goes above that opening, now it's offering buy side. What will it be doing after that? It will be looking for buy stops, buy stops, buy stops, because it's offering buy side liquidity. See, you guys don't even know what you're talking about. You're trying to teach my concepts and you have no idea what you're doing. You're talking about things in the left side of the chart. Trade it, do it, okay? You don't even know what you're looking at. And you're hurting the people that you call your students. And then right away, when people don't know how to use them or understand what to do with them, they'll say, well, this stuff doesn't work, because they learn from somebody that doesn't know what they're doing. Okay? It's blatantly obvious what it is, but okay. Same thing here. Buy side is being offered until that opening price is violated right there. Then the change of state of delivery occurs. Now the market's going to be doing what? Offering sell side liquidity. What's that mean? It's going to start going lower and attacking the sell stops. All the sell side liquidity. It's offering it to the marketplace. That's what's happening. That's what the algorithm is doing. That's what the algorithm does. Okay? You buying and selling, me buying and selling, everybody over there on Reddit is not going to change anything at all. It's not going to do anything. And the argument that defeats all that buying and selling pressure is, how do you argue against the bull squeeze and the bear squeeze? There's a short squeeze going on, and the market's rallying up when it's been bearish. That's just their cop-out. That's their way of saying, well, you know, everybody's shorting, and now they're covering. So there it is. And I learned the same thing, folks. I believed all that garbage. 2,000 plus books. I know what those books told me is what you are learning too. Because the same people teaching today, retail garbage, Elliott Wave this and that, it's all stupid stuff, man. It has nothing to do with why these markets are doing what they're doing. Zero has nothing to do with it. Don't worry, I got proof today. But the market goes down to that 50% level. because it's going down to what? I teach you. What did I say in the first video? It's going down from a premium market relative to this low and this high. 50% is here. That's equilibrium. So it's going to go down to a discount. And that's that gap right in here. It doesn't look like a gap so much here. But if we go back up one more time, that's that single opening right there. On a 2-minute chart, and then on a 1-minute chart, it's 2 candles that make that up opening.
Then I said all that, and I ain't even looked at this. I ain't even made this far in the video. Last time I saw this video probably was like forever ago. Probably like an actual year ago. But then what did I say? Everything I said. Everything. I'm about there.
Right there. On a 2-minute chart, and then on a 1-minute chart, it's 2 candles that make that up. But you're going to have to do is go through a progression of going from the 3-minute, 2-minute, and 1-minute chart, and you'll get your market structure and your areas of where it wants to look for an imbalance or old low, old high, and it just makes it easy. But just a real nice delivery there. And here's the lipstick on it on the 1-minute chart. Swing high is broken. Market structure is now bullish. Rallies. Taking buy stops. Taking buy stops. Taking buy stops. This right here, these highs right here, is just staying below that low. It's building up more interest that this is what? Resistance. That is engineering liquidity. That way, when this runs above it, those individuals that know what you're learning today, they know that that's a pool of liquidity for buyers coming in at a high price. Why is that useful? Because smart money that bought down here, or here, or here, or here, or here, that's where they sell to high seeking buyers. It's not hard logic, folks. It's not complicated. Okay, it just feels complicated because you see other people trying to teach something and you hear or read in the comments, you're teaching it better than ICT does. No, you don't. No, you're not. You're actually teaching it incorrectly and without the real context of what it is that you're missing. But I get it. You think every down closed candle is a bullish order block and up candle is a bearish order block, and that's not the case. Look in here. Okay, for the guys that say I did not take trades or I didn't trade this way, you see that gap right there? See that? See that down closed candle right there? That's your order block. Boom, buy it right there.
Order flow.
What about this? Right here, dropping down. All these candles here are more significant if you look at it on a 2-minute chart. See that? It becomes one order block. Right in here. Buy it, sell short, buy it again. We got up into the stops, sell short, reverse.
See what I mean though? Look at all of this. Liquidity above here. Come back, touches it, and continue upward. Then it inches up like it wants you to like buy right here so it can sell and take you out. Then it just revisits this order flow and then it just runs back up again. Then it shifts. Now where liquidity at? Liquidity is under this low right here. See, it goes right there. Liquidity under this low right here. It goes right there. Simple as that.
And ride the larger swing down. Don't listen to these yahoos out there that say that I'm not proving something to you. I'm proving it. That's what I said I was going to come out here this year and do. That's this whole point of being here this year. It's my 30th anniversary, November 5th. I've been a trader in the markets, living and breathing this stuff for 30 years. You're not really in any position to demand anything from me. I enjoy doing this, but I don't need to provide any kind of proof to you either. But I'm loving it this year. I'm slowly putting it out there, and enjoying all the naysayers and the things they're saying. And it's just fun because they have no idea what I'm about to bring this entire year. None of you are going to doubt anything. So the 1 minute chart, just a real nice delivery here as well. Filling in that fair value gap. Changing the state of delivery. Now it's offering sell side. What's that mean? It's going to match up sell stops. It's going to keep going below old lows into an imbalance until we get down to a discount. Is that hard? Is it hard to see what I'm showing you here? Pretty clean, isn't it? Clean chart. Now, I don't have all these things on my chart when I'm watching price because I already know what I'm looking for. And I don't want to have any distractions, and I don't want to have a level or some kind of annotation that's going to keep me thinking only with that perspective, okay, or that idea. It allows me to be fluid with what the market's actually doing versus going in and saying, okay, this is what I think is going to happen, and this is the only thing that can happen. You understand what I just did there? I allow myself to be flexible, whereas if you have all these things you're putting on your chart, you're only seeing your will be done. So I keep my charts clean.
Now let's test this stuff. Now let's just use the market and figure out what we just figured out. It moves from fair value to order flow, fair value to order flow, fair value to order flow, fair value to order flow. That's just confusing right there. It's just a 1 hour time frame anyway. So for order flow, fair value gap, order flow, fair value gap, order flow, fair value gap, order flow. Yeah, it's just getting confusing right there. But liquidity is up here, so it went back up. Once it came up, came a couple equal highs, took out this order flow, took out this liquidity, then came back up, straight back up, get more people induced, came back down, took out the liquidity under here, under this point, because they thought it was going to go up. Then boom, came running straight up amazingly. Then it came back where? I don't know. I can't solve it all today. I ain't want to solve it all. Then it's pulled back to this order flow. Well, this old liquidity. I don't know. Because this is a new range being made. So how do I move when I have no previous price range? For value, got the order flow. For value, got the order flow. There's liquidity above here. You run to it. Make a new high. Then we change structures. Pull that, go to there. Make some order flow here, cause that right there. Pull back up. Then we sell. Hold that. See this coming up. Wait for this. Buy. Order flow to fair value gap. Come up here, does it break that? No, so we sell. Continue downward. Boom. Hit this area right here. So boom, we buy. Go up. But there's nothing else really down here for us. And we run up. Break this high right here, then we consolidate, well, make order flow, come back down to above here. Okay, cool. Run up. Dang. I done figured it all out. Well, all that I need to anyway. Breaks that liquidity. Jeez. There ain't no point in market structure. No wonder.